The information flow is endless, and with so many sensational headlines, changing policies, and market fluctuations, it can be tough to keep up with what's most relevant to you as a real estate investor. In Boardroom Brief, we endeavor to discuss and provide our point of view and insights on relevant topics that matter to Greybrook, our investors, and the broader real estate community. Our goal is to provide you with expert opinions in 20 minutes or less.
Guys, thanks for joining us, Boardroom Brief. Appreciate you making the time. We have a cameo appearance by Brendan Crombeen, the Executive Director of the Private Market Group here at Greybrook. Thanks for joining, Brendan.
Thanks for having me.
All right, guys, we just wrapped up our annual Inside Track event. Over 450 investors came together to hear our keynote speaker, Benjamin Tal, the Deputy Chief Economist at CIBC. We also had some wonderful panel discussions with policy experts and industry leaders. Discussion centered around three main things, right? We had the US trade policy. The result of that trade policy is slowing down Canada's real estate market and the role that government must play in unlocking supply. Now, perspectives varied, opinions varied, but there was a consensus that policymakers need to get bold, take action, and also that all market participants need to get creative and offer innovative ideas. Now, the common goal with all of these comments is that we need to get to a place of economic certainty. That is the key catalyst that's going to put us back on a path to prosperity. Sasha, when I was watching Inside Track, I noticed the audience visibly engaged with Benjamin's presentation, given the fact that so much of what he was talking about is how the US trade situation is tying back to real estate and overall consumer confidence here in Canada. Reflecting on that presentation, what would you say is a key takeaway that our investors need to pay attention to?
Well, you know, I think you kind of hit the nail on the head. Those are the three main takeaways, and they're all sort of intertwined, I think, right? I mean, obviously, macroeconomically, the uncertainty that exists geopolitically and geoeconomically, I think, predominantly around trade policy, but there's a few different factors. I think that has to kind of find its way to resolution. I think that'd be kind of first and foremost. When talking about the real estate market, you know, I think a big part of it is confidence, right? I mean,
Sure.
we always talk about the fact that there's a real supply issue, there's real demand, and there are also real issues, right? Affordability, you know, the direction of interest rate. And I think for things to start to resolve themselves a little bit on the real estate side, there needs to be a little more certainty and confidence in the direction of the economy, which then sets direction for interest rate policy, which then I think filters down through the housing market. And I think Benjamin did a great job of summarizing it. It's not a very straightforward path, unfortunately.
Yeah.
So I think it'll take a bit of time, but I do think that's the order of operations. I think, you know, sort of economy and geopolitics first, you know, followed by, you know, policy thereafter. And I think the last part of it, which was government's role. You know, I've always felt that government in times like this has the job of stabilizing industry, whether that's the housing industry or, you know, auto back in 2007, 8, 9, and banking back, you know, during the global financial crisis. I think in this particular case, government can play a great role in stabilizing the market and introducing incentives, but also introducing different tools that the private sector can use in order to get the market back on track and back to building housing, which I think is a very important part for Canada, not only for those of us who are real estate investors, but broadly speaking for kind of the prosperity of the country and where we can go economically. So I think that you know, government will step in to do that. They've indicated a number of different avenues. Some I think sound great, some maybe less great, but I do think that the fact that all three levels of government are thinking about the problem and how to address it is a huge step in the right direction.
And Brendan, like the panel had all kinds of different market participants, right? And even amongst the panel, there seemed to be a consensus that as market participants, we need to get more innovative. We need to become creative with delivering solutions. Is there like a key takeaway from the panel discussion that you thought resonated with you?
Yeah, I thought it was, really interesting that everyone, as you said, everyone is aligned that change needs to happen. And I think it's, something we talk about a lot, that it feels like the first time that all three levels of government, everyone in the industry, from developers to investors to builders, is all aligned that change needs to happen. And again, I think, going back to what Sasha said, some programs or different things that are being talked about, I think could have a great impact. Other parts of it, I'm not so sure how it would play out. But I think the interesting piece during the discussion at our Inside Track event was really around, that this needs to happen. It needs to happen boldly. It can't kind of dip our toe in the water and try one little program and see if that makes the changes we need. There's a real need for housing. There's a real need to get supply online. There's a real need and desire from developers to build that housing. So again, I'm encouraged and excited to see where things go. And, again, obviously it has been a challenging time in the real estate market, but I think it's going to lead to real change that will make the industry, more sustainable and put us in a better position as we get out of this period.
Absolutely. And when we look at housing overall, and this is not traditionally an area that Greybrook participated in, but the panel discussed it, and there's a lot of headlines right now. I recently read an article on Stories, describing about a dozen or so sites that have now converted from condo to purpose-built rental, right? There sort of seems to be a theme. And obviously Greybrook evaluates these possible opportunities. Sasha, could you touch on what sort of elements we look at, and when does a condo site potentially pencil out and underwrite as a PBR, as a purpose-built rental site, and what variables are we looking at right now?
Mm-hmm. Well, I think right now, it's tough to make anything work, right? I mean, I think responsible underwriting, whether it's a condo or a rental or anything else, presupposes that you try to see the world as it is today and leave less to forecasting the future. And if you're gonna do that, you're gonna do it on the downside to make sure that you sensitize it and you can still, make the type of return or protect yourself in a down market. But you're really not looking to try to, take aggressive assumptions on the future. And I think one of the challenges right now in this particular environment with purpose-built rental specifically is, rents have come off, right? And,
sure.
And so the question is, there's been a bit of an influx of supply over, there's a lot of deliveries in this period of time. Obviously affordability and our inflationary environment has led to sort of other affordability challenges across the board. As a result of that, rents have leveled off and in fact gone backwards. Mm-hmm. So the question you have to ask yourself is, it's all a timing game, right? I think we can all agree in the future, you expect rents, but stability and vacancy to come back down. But the question is when, and when you're underwriting purpose-built rental specifically, time is really of the essence in order to make the returns work, because in purpose-built rental relative to condo, it's quite equity heavy. So what that means is, when we're underwriting a condo building, normally speaking, you're gonna capitalize it with the equity, which is what we are, in a way where it takes into account purchaser deposits and the additional source of capital that represents, and that enables you to kind of generate the return you're looking for with a lot less equity than a purpose-built rental.
Yeah.
So the combination of, more equity requirement and uncertainty around two key features, rent I touched on, and cap rate.
Sure.
Right? Because I think on a macro level, we all feel that cap rates are likely to compress more than they're likely to decompress, mm-hmm. based on a number of different factors, not just interest rates. Interest rates are one variable, but liquidity that's sitting on the sidelines, different things like that. Rates of return that you're getting in the bond market versus what you're seeing and equity markets versus what you're seeing in real estate. But I think even though we feel that way, we think it's irresponsible to bank on it, right? Mm-hmm. So when you're underwriting something with more equity than you would otherwise have, rent where the trajectory is not as upward sloping as it was, and cap rates that are probably decompressed by 25, 50 basis points relative to what they should be, that makes it really difficult to make the math work. So I think the government, when they're talking about purpose-built rental and trying to create incentives around purpose-built rental, whether that be MERB or other things, they're really trying to address the gap between what makes sense on an underwriting basis and what today's reality is. And if you can do things to either create more incentive for the money or lower the cost, then you're making that gap smaller. So we're certainly looking at it on every site that we have that's a high-rise site. Not because we don't think that the condo market will come back. I think it will, time indeterminate, but also trying to figure out how quickly we can move to be able to protect our capital and generate a return. And in some cases, we're closer than others based on the area, based on something that's on the subway in the middle of downtown Toronto versus maybe in Whitby. We don't have a lot of high-rise outside of Toronto, but generally speaking, your land cost base, there's a number of different variables that you have to look at to see whether or not it works. I think we're inching closer to that on several fronts, and hopefully with what comes out in the budget in November, there'll be some additional incentive that just kind of further reduces that gap. And between that and maybe some movement in the market, interest rates going down, maybe some cap rate compression, you're going to start to see it pencil out a lot better.
Yeah, I think to sort of talk on incentives and the government sort of using tools and levers in order to spur housing. Brendan, we've talked about MERB, development charge subsidies. They're coming out with whatever they call it, the WAR catalog of modular homes. Lots of sort of different tools in their toolkit. Given all these levers, where do you think the government can make the most impact in the short term?
Yeah, I don't know that, my own personal view, I don't think there's one lever that's going to change the market. I think that's, what a bit of the challenge is. There's, deep, complex challenges and issues with it today. And I think, they're all meant to bring costs down. As we know, and we spend a lot of time talking about, development's a margin-based business. And when those numbers don't align, when, costs get too high and revenues compress, it creates a challenged environment where nothing's getting built. We talk a lot about how we invest in the fundamentals of the market. There's a need for housing. We need housing delivered in these markets that we're invested in. But as we've spent a lot of time today and in previous episodes talking about, the math doesn't work currently on a lot of these sites. So, trying to find a way, whether it's through financing programs, whether it's through development charges coming down, whether it's through different incentives, to incentivize capital to go back to work in these assets is really what's going to drive it. We spend a lot of time talking with clients about that it's not a simple one thing. We need prices to go back up to start building again. There's, a wild number of variations that could lead to the market getting going again. And again, I think we all believe that one of the biggest things is that uncertainty in the market. So again, I think, with the introduction of some of these programs and the numbers starting to make more sense, I think you're going to see a confidence come back. You're going to see, obviously we've talked about and was a big topic at Inside Track, as interest rates come down, buyer confidence comes back into the market, as there's certainty on tariffs and what our trade agreements are going to look like, certainty in the economy, that all trickles down to the real estate market. So again, I don't know if I would say there's one singular program that I think is going to kind of turn the market overnight, but I think there's a lot of great programs that are being talked about. And again, that's why, as I mentioned earlier, I think it's really got to be a bold move. It can't be, hey, we're going to try this one thing, see if that works, and if it doesn't, then maybe we'll add something else. I think we have to look at it holistically and know the longer we wait, the bigger the gap there's going to be in that supply coming online, which obviously has other ripple effects in the market.
Yeah, it seems like the desire isn't let's make a rounding error at one level of government, but it's like let's be bold at every single level. It's going to take a lot. And hearing you sort of talk about timing and hearing what the panel talked about with respect to the market right now, it seems like it's not a dynamic shift in demand that we're experiencing. It is, in fact, a timing situation with all of these sort of variables that are playing against the market right now. Sasha, as this sort of timing shift starts to dissipate, do you see certain opportunities emerging for Greybrook, and are there opportunities we're kind of keeping a close eye on?
Yeah, I mean, just kind of address, I think Brandon, everything you said was right, and just to address kind of the view on the market as a whole. Like I look at going forward, I don't know exactly when at this stage as we sit here today, because there's all the variables we've talked about, but I see some structural change in how housing is financed and delivered. And I see that structural change as being positive, right? So looking backward, it doesn't help us when you look at the euphoria that was in the market and kind of how, we had a lot of volatility. People don't love that in our industry, and you guys know that. It's I think to the outside looking in, it looks as though, wow, it's great, prices are going up so aggressively. But that has a ripple effect. When prices go up aggressively, so do the cost side of the equation, and the cost side of the equation is stickier than the price side of the equation, as we're seeing, right? But I think some of the changes that are being discussed at the government level, I think some of the changes about how investors and developers are looking at development going forward is going to lead to in my opinion, a much more durable cycle as we enter this next cycle. So what does that mean for us as investors? If I were to kind of boil it down into a couple areas of focus, we're looking at land acquisition that has some time to market. So we're not necessarily looking at something that's approved and ready to go today, obviously into a market that we don't control, that today isn't very robust, putting it mildly. So we think we can add value through a planning process, and we're prepared to take that time. And we think if we buy it at the right price today, there's a lot of upside when the market does start to realign itself. So I think those opportunities, and we're not this, I don't think we're not bullish on high rise. We would buy high rise at the right price, and in fact we have bought high rise at the right price. Same as low rise land. Like I think we're really focused on, we feel our thesis, our investment thesis has durability to it, and so we're not changing the thesis. It's a question of timing, and so that's why we're buying things that are a little earlier in the continuum. For investors, that typically means longer timelines, but we think it's a better investment at this point in time. And we also think on the timeline, we learned a lot over the last number of years as things have changed, and we've sort of, I think, being very realistic about timelines, and if anything, they may get better, not worse, based on how government is looking at the problem and wanting to get rid of the red tape and wanting to make sure approvals can happen quicker. So for all those reasons, we're looking at those things. And then the other category I think that we're looking at and doing a lot of is residential real estate that's cap rate sensitive. And that's like the value add stuff and all that kind of thing. And I'll put it like this. Whenever we buy anything, we are not modeling cap rate compression. So we're assuming that cap rates stay as they are today. And we're engaging in an active strategy to grow the net operating income, and that's the whole investment thesis. However, if we're right about the likely direction of cap rates, then we should see a tailwind, right? So I think the risk reward of that investment at this point in the cycle is exceptional, because you're buying something that makes sense today, that you're adding value through an active strategy. And at the same time, if you're right about where the macro goes, then you're taking your return from what you thought you were going to make to something quite a bit better than that. But you're not relying on it. So those are kind of the two broad categories of investment that we're really focused on.
Yeah, it's like the market delivers a bonus essentially, right? Yeah. Where your hard work pays off, and that's the base case. But if the market performs the way a lot of analysts think it will, it'll deliver a bonus. On that topic though, and you touched on this, Brendan, with respect to the shortage that's looming, right? So again, the panel didn't agree on everything, but the panel did agree that come 27, 28, 29, when all the cranes we see in the sky right now are gone, there will be a shortage. From a private capital markets group and from sort of the frontline investor that we work with, they're sitting on the sidelines, they've got some dry powder. What advice are you giving them right now?
Yeah, I think a lot of the conversations I've had with investors on this is largely everything we've talked about. There's a fundamental need for housing in these markets. Obviously, the way we're looking at these investments is, as Sasha just described, we're looking where, again, we look at what are the risks in this, what's our downside protection, and is there an opportunity for outperformance? So again, a lot of what we've been looking at and seeing, a good risk reward balance in is some of this longer dated land development with housing, obviously. That again, we believe if we're making sense of these numbers at today's dollars and today's cost, there is potential that those can have the opportunity to outperform, as he talked about on the value add, kind of the same thing. We have a thesis, we see an opportunity, and we see some potential tailwinds behind these. So again, we're looking to kind of deploy capital where there's a fundamental need, there's a demand, although it might be muted at the moment, given everything that's going on, and trying to align those timeframes as best we can. So again, I think, what I spend a lot of time talking with clients about is that in particular, that, real estate market's going to have cycles, there's ups, there's downs, there's different things that are driving those things, but we're not a shop, or I wouldn't encourage people to take flyers that, everything has to go right and you have the potential to hit a home run, but rather, stay disciplined with your investment approach, look at the fundamentals of the market, the fundamentals of the investment. And, again, I think you can really set yourself up because of, again, some of those driving fundamentals. When you to kind of add a little bit more on that pending lack of supply. I mean, again, if we put a shovel in the ground today on condos, which is not happening very much and really is how we deliver mass quantities of housing in major cities like Toronto, that's not being delivered till 28, 29, 30. And the fact that there's been very low sales over the last 12, 18 months, and again, I think there was a lot of debate on this in the panel, but I wouldn't say there's a lot of confidence that's going to return in the next 1, 2, 3 months. That's, over the next 12, 24 months, there's a belief that as some of this stuff gets flushed out, as the market kind of demands what the market demands, is it different unit types? Is it different ways that they're being financed by developers or delivered to end users? That demand will come back in the market, but there will be a gap. And I think the question really now is, how long is that gap? Are we sitting here for 6, 12 months with demand in the market and no product being available? Or is that 2, 3, 4 years? And obviously, we've seen that movie before, where when we have demand in the market and there's not enough product to meet that demand, obviously the impacts it can have to the market, which, as Sasha made the comment, that's not what developers want. That's not what consumers want. I think everyone would be much happier and more content with kind of a normalized, stabilized market versus these crazy ups and downs and different factors that are pushing the market in these directions. So, yeah, I think it's an interesting time, but something that we see a lot of opportunity by kind of sticking to the fundamentals of what we always have when we look for these investments.
And if I may just add to that, it's really hard to do. So the psychology isn't easy, right? So, but if you look through history, and let's say you had a big tech portfolio, and that tech portfolio in 2000 didn't look so great.
Yeah.
But let's say you loaded up on tech in 2000, then you would have killed it in the aggregate.
Yes.
You look at the global financial crisis, the exact same thing, right? If you had a bunch of banks, it didn't look good at a period of time. And then if you dollar cost averaged down into the banks over the long term, you killed it. Auto, same thing. Okay, so what's the theme there? The theme is those are all industries where they weren't going away. Like the fundamentals were there.
Yeah.
Technology companies were going to exist. The banks were going to exist. You didn't know which ones, but you knew that the industry would survive and thrive. I think this is the same. So when we talk to investors, it's hard psychology at points in time to sit there and say, hey, I know you have a high-rise portfolio that isn't looking so hot today, but we're just buying this thing over here at $50 a foot, you should buy it. Their gut reaction is like, what do you mean? But if you think about that one you're buying today is more than likely to outperform given what's going to happen over the next cycle. And that's going to help balance out the returns over time. So I think key is diversification, and this industry is not going away. And this investment type is not going away. And that we have full confidence in. We can't sit here and say 6 months, 12 months, 24 months, but that's why we're giving ourselves the runway with the things we buy today. So, it's not easy to do, but that's how professional investors have to look at it.
Yeah, and we're not, I think to your point about value add, not depending on cap rate market dynamics, right? We're adding value. And, when I talk to investors, I make the argument, well, essentially everything we do is value add in its own sense, right? Whether we're adding value to raw land or whether we're adding value in another way. The fundamentals we're discussing right now are the fundamentals of how do you actually work on a parcel or how do you work on a site and bring value to that site. What happens at the macro level and what happens with market dynamics, I think is, to your point, the tailwind. But really the base case is through the work that we do. I want to touch on something Brendan said, Sasha, with respect to timelines on shovels in the ground, which is generally speaking, call it for high rise 3 or 4 years. That's from the time that the site is financed and approved. So you still have to get to that point. Peter brought up an interesting comment during the panel discussion about this sort of sway of voices saying we need to build more for the end user. And one thing he discussed was with respect to the end user doesn't typically buy housing 4 years into the future, right? It's difficult to family plan and live life around that sort of timeline. And he brought up that Toronto and Vancouver and a few cities in the US are unique in the way that we structure financing, and whereby a sales center has to launch, a bunch of people have to sign contracts for the future housing, and then the bank will finance you once a certain amount of contracts are inked. We talked about the market participants needing to play a role, become innovative, et cetera. Other markets where developers are building the product and then selling the inventory exist. Do you see that potentially coming to Canada? And if so, where does the independent investor get involved?
Yeah, I mean, it's possible. I think that the way, your comment about end user versus investor, I think is a good one. If you look at low rise, generally speaking, end user driven, because
Yes.
the time to delivery is a lot quicker.
Sure.
So people think about downsizing, they think about, I'm going to sell my house and move in a year's time or whatever the case is. High rise is a little more ambiguous on the planning, especially because timelines in a lot of instances have been somewhat indeterminate in the process itself. So they're going to improve on that through different policy measures, I think. But it's still not going to bring end users to that market. So today, when a high rise is financed, it draws a lot of investors because it's really the financing structure that is driving it, right? The bank is giving you a certain percentage of cost by way of senior debt. Equity is a certain percentage, and then you have those per share deposits that fill the buffer. If you think about sort of how it's done in a lot of places in the US, it is done differently, so they don't pre-sell. A lot of that is driven by legislation, the fact that you can't use those deposits in any way. But having said that, there are different funding models where either senior debt is a little more aggressive. So they're willing to lend a slightly higher percentage on the cost.
Sure.
There's a world where pref equity and mezzanine finance plays a role, and as well, I think there's a world where we're a little heavier on the equity in these things. I think that other funding models are generally effective as well, and that might be some way that this market gets back on track, because I don't know how quickly investors will be back in the market. So in the meantime, between some version of cost reduction vis-a-vis policy measures, some version of greater affordability vis-a-vis lower interest rates, and not just policy measures on the cost side, but also interest rates benefit people like us because it's part of your construction loan. It's a lower cost of debt. The fact that nothing's getting built, there's a little bit of idle capacity in the industry, so that's kind of helping reduce some of the costs. So a combination of all those things, plus potentially some innovation on the financing side. A lot of that isn't in our control. So like the way that we have to look at the world, unfortunately or fortunately, is there are certain things that we control and there are certain things that we don't. We do not control the market and when it returns. We do not control policy, and we do not control how banks lend. The latter two we can have influence over, right? We engage regularly in discussions with the government. I do personally. Peter's always talking to the banks and seeing if there's any way that we can bridge that gap. But really where we're spending our time is trying to understand the cost side and whether there's any further costs that can be drawn out of the model, not policy related, right? So things like making buildings more efficiently, thinking about layouts and making them more efficient, to Brandon's point about different unit mixes and things like that. And as well, I think we also spend a lot of time trying to understand whether there's potentially more density we can add to increase the revenue side of the equation. So we really, really focus there, but we're also very active in talking to banks, talking to government to try to continue to bridge that gap. Every day right now is an exercise within our existing portfolio of understanding what the problem is. There's a spread between the bid and ask, so to speak.
Sure.
And pulling every lever we can, some of them together with other industry participants, some of them individually, to try to reduce that gap. And the one side we don't have control over is the revenue side, because that's a market-related thing. So we're focusing over here, and then eventually when the revenue side starts to stabilize, then hopefully we made enough progress that we can get into the ground on some of these things a lot earlier than even we anticipate.
Yeah, the banks, I think, will play a role no matter what. I think, to your point, it'll just be interesting to see where the different key players line up. I'll end it with this, sort of my favorite type of question, the crystal ball question. So we've been through Inside Track. We just had a great discussion on a little debrief about what happened there. What's one thing that you have the most conviction about over the next, call it 12 to 24 months, regardless of what happens in policy, regardless of what happens on the macro level? What's one thing that you're just, if you were a betting man, you'd place some chips on?
It's a tough one. I would say, honestly, I think if I was it might be a bit of a cop-out of an answer, but I would say that the industry is going to change. There's going to be change in the marketplace, which I think is welcome. Again, I think there's so many variables to that and so many layers from, again, government, banks, developers, investors, et cetera, consumers, that's going to drive how and where and what that looks like. And I think it's, candidly a little early to say what that is going to look like. But I do think that there's going to be change in the marketplace, and I think that that's exciting after going through the period we have and knowing that there needs to be change to create a more sustainable pathway going forward. So I'm excited to see what that change looks like.
It's a politician's answer. Thank you. Sasha, what do you think?
Listen, I'm gonna make a call, and this isn't a pitch. This is, I think, the things we buy today. If I had to bet on them, which I do because we put our money in the but proverbially, if I had to bet on them, I would bet them to be outperforming, because if you can, we're in, by all consensus, the worst period of upside down between revenues and costs and ambiguity and uncertainty that we've had since prior to 1990. They say 1990 is not as bad as we are now, right? So you're talking about a massive generational period of time we're in, right? If you can make the math work on something in this period of really fuzzy stuff, I mean, the likelihood, given all the fundamental supply-demand things we talk about, the likelihood of that getting much better is really good, right? But timing matters. So again, if I was buying something today and I was paying a price that I would have paid 2 years ago and it's approved, well, then I'm an idiot, right? On the other hand, we're buying a lot less things, but the things we are buying are priced in a way that they make sense in this thing that doesn't make sense.
Sure.
So I bet those will be, really outperforming. So again, it doesn't really help a lot of the things that we own. We got to deal with the issues that we have, and hindsight's always 20/20, and nobody could have predicted the world we're living in today. And we'll deal with them, and that's part of the job. But I do think that the things going forward are a unique generational opportunity in my mind.
Yeah, it makes sense. It's like buy low, sell high, right? It's
it's easier said than done, as we all know, right?
Sure, yeah.
Because I think psychologically, it's that's just, you look at any asset class, you look at any period of time, you can see the most outflows when the market's getting killed,
yes,
and the most inflows when it's at its absolute
when it's
peak,
raging.
right? So I mean, but part of our job is to try to see through that and all that kind of thing, and it's not easy to do, and people would realize we're not buying a lot of things. It's not because we don't believe in the upside, it's because expectations are slow to adjust, right? When you're trying to buy that property, and 2 years ago it was $3 million an acre and you're trying to buy for $900,000 an acre, you know, not always easy for the vendor to get there. But in some cases, you can pick these things off, and when you do, I think that they have a special place in the portfolio for sure.
Definitely. And listen, we're not just buying; we're also executing. Right? There's two components. Thank you guys. Really appreciate your time today. Just one note for our audience: if anybody wants to look or view the Inside Track in its entirety, there's a link in the comments below. So make sure you check that out. Thanks for joining us, guys.
Thank you.